What is net operating loss NOL carryover? Have you ever wondered how businesses can turn a financial loss into a future tax benefit? Today, we will discuss the concept of net operating loss carryover and how it can impact tax planning and charitable giving strategies. A net operating loss occurs when a business's allowable tax deductions exceed its taxable income in a specific year. This situation results in a financial loss for tax purposes. But here's the good news. Businesses can use this loss to their advantage. By applying it to other tax years, they can reduce their taxable income and lower their tax liability. Now, let's break down what NOL carryover means. This term refers to the ability of a business to apply a net operating loss from one tax year to future tax years. This allows businesses that experience losses in one year to offset taxable income in profitable years. It effectively smooths out income fluctuations for tax purposes. One key point about NOL carryover is its duration. Under current tax law, net operating losses can generally be carried forward indefinitely. This means there is no expiration date on using these losses in future years. This indefinite carryforward replaced the previous limit of 20 years. However, there is a limitation on usage. When carrying forward a net operating loss, the deduction is limited to 80% of the taxable income in the year it is carried forward. Even if a business has a large NOL carryover, it can only offset up to 80% of its taxable income in a future year. Now, let's touch on carryback restrictions. Unlike carryforwards, carrybacks, which apply the net operating loss to prior years for a refund, have been largely disallowed for most businesses since the Tax Cuts and Jobs Act of 2017. There are some exceptions, such as certain farming losses. However, temporary provisions allowed carrybacks for net operating losses arising in tax years 2018 through 2020. In accounting terms, net operating losses are considered deferred tax assets. They representing future tax savings and are recorded on the balance sheet under non-current assets. This reflects their value in reducing future taxable income. For businesses, especially startups or those with fluctuating income, NOL carryovers are helpful tools for tax planning. They provide relief by reducing taxable income in profitable years, improving cash flow and financial stability. In the context of estate, tax planning, and charitable giving strategies, understanding NOL carryovers is important. Net operating losses affect taxable income calculations, which influence the amount of tax owed and the potential for charitable deductions. When calculating charitable contribution limits, NOL carryovers from prior years are considered. This can impact the allowable deduction amount. Overall, NOL carryovers serve as a strategic tax tool that helps businesses and taxpayers manage income variability and optimize their tax positions over multiple years.